All the buy signals we can give, all the green lights we can turn on, have turned on. And so basically what we're saying is the game's on now.
Here at Liberty and Finance, we're licensed brokers with Miles Franklin. We are standing by the inventory, ready to make sure you get what you need, even into the wee hours of night and on weekends, because preparedness doesn't stop. Call us 1-888-81-LIBERTY. That's 1-888-815-4237.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Good to be back, Elijah.
Well, it's great to have you, and it's been quite exciting times in the metals markets as we've seen gold pop above $2,000 an ounce, silver above 25. Now they're taking a bit of a breather here, going below those levels now today as we speak on Monday. But your take on the dramatic run-up that we have seen?
Yeah, as we came up off the September lows, and silver bottomed first in early September and gold in late September. As it came up off those lows, MSA issued in our constant reports layered buy signals, meaning looking at a given metric, we saw a structural breakout. In other words, it's initial buy. What we would call our final buy signal occurred last week, and especially for silver. There was a level on a very long-term momentum chart we keep on silver that had been approached and approached and approached three separate times since early 2021. And they all those highs, even on price, they were lower. They were like a downtrending channel. On momentum, they were flat. And last week's action, first week of April, punched through that. And if you also examine a silver price chart, like a monthly especially, bar chart, and you go back to the summer 2020 highs and action since then, there's a broad parallel, gradually declining downtrend channel. While gold was in a sideways range, silver was in a downtrending channel. We blew through that even on the price chart by getting up to 25 area in the recent rally. So as far as we're concerned, we can't offer any more buy signals unless you just want to look at a price chart and say, wow, we just took out the summer 2020 highs and on silver, and that would be taking out 30. But that's a lagged, as far as we're concerned, that would be a lagged signal. Already our momentum signals have said we're all in. Now, we also expect silver to outperform gold. It underperformed gold during the corrective process the last 2 years. While gold was more or less sideways with a brief false downside break, silver was in a downtrending channel. But that's changed. And if you just go back and look at the September lows, like on GDX, the gold mining sector, silver, and the September lows in gold, gold's rallied 25%. I'm talking as of Friday's close, off that low. Silver, about 45%. And GDX almost 60%. So while even though the miners aren't back to their highs and silver's not back to its highs, the percent gain they've had off those lows has been dramatically more than gold. And that's the behavior that we expect to see going forward, is gold still going up, but the miners and silver catching up and outpacing it.
Now, you mentioned you're not really releasing any buy signals right now. Do you think the metals are overbought at the moment and we could see a further pullback? Or
No, I think we just had all the buy signals we can give, all the green lights we can turn on have turned on. And so basically what we're saying is the game's on now. And then we think if you're going to be long, you better be long. Okay, don't wait for taking out $30 over, because frankly, we think, and I put out in the weekend report a logarithmic scale chart of silver going back 50 years. And you can see there's two run-ups to $50, and when you put it on a log scale chart, the action of the last couple of years looks a bit different. In other words, it looks like instead of pulling back deep, as silver did after the first $50 high and after the second one even, this time the pullback was about halfway and more congestive looking, not a sharp pullback. Even though everybody in the market thought it wasn't really. And it looks like a flag type situation. And I'm going to bet that one, you're going to take out the $30 high. The high early actually occurred in March of 2021, the silver high. Gold's high occurred in August of 2020. Silver almost got to $30 then, but then later got to 30 in early 21. But when you take that out, I think it'll be a rush toward the 50 area again. Because frankly, there is nothing on the charts, if you're a price chartist, for example, between the highs that we've seen in the last few years, either side of 30 and 50. It's just a void there. So if you're a potential seller, you frankly don't have anything to latch onto. It's just a thin air. And so the only thing you can see as a price chartist would be, gee, it stopped twice at 50, maybe it'll stop there again. We bet it doesn't. Okay. But right now we're fully bullish on silver and gold with an emphasis on silver.
Now, it sounds like, do you have any sort of time frame of when you see silver breaking above 30 and then heading towards or above that 50?
I think it'll go through 30 soon. I think what we've broken through in this surge that we had a surge early in the year, if you recall, and silver got up to like 2470. Actually, 2475 was the high tick. And then it pulled all the way back down to like 21. Taking out that high and clearing the price channel that I described and blowing through that momentum ceiling that I described should hasten the action of silver toward taking out that 30 high. So I don't think it's like we'll be there in 3 or 4 months. I think it's more likely we'll be there in a month or two. I could be wrong, but I don't think so, because the structures we just went through, both on momentum and price, indicate the beginning of something, not something late. And so usually at the beginning, as soon as you unleash, there's this vacuum effect. So I would expect a challenge of the highs, silver size, soon. Now, gold's already there. In fact, last week's close on spot gold, which is the April contract, very illiquid right now, but it's there, was 2011.90. And I'm talking weekly close, not intraday highs. You go back to the 2020 high in the summer. The high close was 2010 and change. So we actually closed about $1 higher than the highest weekly close in 2020. So on a weekly close only chart, gold just made a new all-time high. And I suspect silver's about to engage in the way that would reflect that.
So if silver does engage in that, what is your anticipation for what are your price targets for gold then? Because it seems like there's really no upward resistance, obviously, once we blow past the all-time high.
Again, the best thing to do is run a logarithmic scale chart, a ratio chart, go back 50 years in gold, where gold was $30 before it was even legalized for trading here, like in the early 1970s. It was trading in the bullion market in the low 30s. When it was legalized here in 75, it had reached 200. Okay, that's almost a six-fold move. Okay, then the 1976 low to the 1980 high was almost an eightfold move. In fact, it was an eightfold move. Then the lows in 2000, which is about $250 an ounce, to the 2011 high was another eightfold move. Okay, so we've had a six-fold and two eightfold moves in a span of about 45 years. So it's not like it's unusual for gold to go up eightfold. Okay, and we certainly have the fundamental macro trend background, both technical and fundamental, to justify gold doing another routine eightfold move, which is to say, don't be shocked by $8,000. It's not even unusual for it to have done that. And it wouldn't shock me for it to go way beyond there. And also, I tend to think that this trend, this phase in gold, is not something that takes us 3 or 4 more years to get there. I'm inclined to think that the cascading of events, which suddenly people are starting to be aware of, like the banking situation, it's going to speed up the process. So I'm on the chaos theory road right now, not the incremental trend road, where I think if you're going to go from A to Z, you're going to do it quickly. And this is true for some other markets as well. Like I think the downside in the broken paper asset bubble will speed up now once we roll over from this multiple redundant rallies we've had since June where the S&P rallies and comes back down, S&P rallies and comes back down. You could draw a line sideways, and all you're doing is this, way off your high. Same with NASDAQ 100. And I think it's a futile process. I think the bubble is broken. The people who don't even realize it's a bubble, are still in there thinking, oh boy, this is a buying opportunity because Apple's acting good or something, or chips are doing well. So in late January, we put out a report when banks were looking real good. And we said, beware of the banks. They're going to ambush you. And we based that on technicals. We know nothing about the specifics of any given bank. Okay. And sure enough, in mid-March, they ambushed everybody. In a matter of weeks, they effectively crashed in percent terms. And I don't just mean this bank or that bank, but the whole sector. And of the big 4 or 5 banks, Bank of America, Wells Fargo, Citicorp, et cetera, Wells Fargo and Bank of America made new lows below the lows of 2022. It's like the S&P now being at 3,000 or something, okay? They did that. Nobody's commenting on that. Why did they make new lows? It wasn't just some regional bank here or there. But 2 of the big 5 made new lows, and Citibank isn't far away. So we think those type of events could speed up this whole process.
So it sounds like a significant drop from here, given current events and just that the bubble is overvalued right now.
When we run annual momentum charts of the S&P, NASDAQ 100, a lot of key stocks, we see total breakage of structures that matter. In other words, trend structures on momentum that were clear floors or clear multi-point uptrend lines that go back 10 years, 12 years. They were broken. Some of them were broken in early 2022, but especially as the year progressed, with the June low and then later the October low last year. Anything left to break is now broken. And what we're having now is when you look at the momentum charts, instead of the price charts being 20, 30% off the high and then having this up, down, weightlifting process. Momentum is hanging in below these violated floors. So if you saw an annual momentum chart of Apple, for example, or which is the strongest of the tech stocks, actually, or of S&P or NASDAQ 100, and looked at the momentum chart, not the price chart, you'd say, oh my goodness, this is really broken. It smacks you in the face. And the problem is that the breakage occurred at what you would call neutral levels, meaning they're not oversold at all. So if you looked at the highs of momentum over the last 10, 12 years on the S&P or the NASDAQ, you would see routinely that the momentum readings would get 40 or so % over the 36-month average. So it was like a normal inhale, exhale, but it wouldn't go below that average. So everything was in the upper half of the momentum chart. Well, we just blew out the bottom end of that chart around the zero line. So you want to go 40% under, then we can talk about a major bounce, something that reflects the highs we've seen routinely over the prior dozen years. Now, when you look at T-bonds, for example, we got bearish in October of 2020, so a full year and a quarter before we got bearish on the stock market. Stock market didn't even peak until like November of 2021. But the T-bonds were already in a negative trend in October 2020, meaning price down, yields going up. If you looked at their annual momentum chart and even their price chart, you'd see, wow, they've collapsed all the way back to the 2009 lows, including price. So it's as if S&P had done what T-bonds did, we'd be down at 1,500. Okay. Now, our analysis of T-bonds is different now. We've gotten off the bear track. In October, we thought there would be a low at a certain level, and they reached that level, got a little bit below at 1% or 2%, and then had the rebound. We think T-bonds now have probably bottomed and are likely to rally, nothing extraordinary, but have an upward bias such that if asset managers want to flee the stock market, they can now go into that alternative category, the 60-40 rule, 60% stocks, 40% bonds. It didn't work last year, but I think this year it would, where you could be relatively safe owning government bonds. This to me says a couple things. One, technically, I can understand why they would rally because they paid their dues full time. They reached our objectives. Had the S&P matched it again, we'd be lower than 1,500 even. Okay, but that wasn't the case. So as far as we're concerned, the stock market hasn't even paid its dues yet. It's just given the sell signal, and now is going to pay the dues in the next leg down. But the T-bonds have paid their dues and look ripe for being an alternative asset category. I don't think they'll be as good of an asset alternative as gold or silver. Gold and silver have potentials on the upside in percentage terms that will beat the safety of T-bonds. T-bonds will at least be stable and offer somewhat lower yields. Market forces, not the Fed, causing that. But anyway, so that's how I see the stock market right now. It's a broken bubble, has not paid its dues, unlike T-bonds, which did.
And as for the Fed, I know that you have previously stated that you do think that the Fed will pivot. Given the current situation in the banking system and what is happening in the economy, do you see that coming pretty soon?
Well, if they're lagged to reality. The Fed has always lagged to reality. Any objective observer would go back in history and say, "Oh, they helped cause this boom by printing a lot of money, and then they got too excessive, and then they altered, and et cetera. So they caused the bust." They're always behind the curve. That's the nature of a non-market force. It's not sensitive to supply and demand. It's only sensitive to its own intellectual decisions. So yes, they're going to have to panic. And I think the bank thing, in fact, probably ambushed them. Because if you'll notice that before the banks collapsed in mid-March, Powell had a testimony before Congress like a week or two before that event. And he was talking as hawkish as you could be, which tells me that, one, he didn't know what was coming. Otherwise, he wouldn't have been so outright hawkish. So he wasn't aware of what, like MSA was aware of technically, that there was vulnerability in the sector that was behaving so well. Banks have been behaving better than the S&P over the last in 2022. It wasn't until March of this year that suddenly the curtains got pulled back. And that ambushed Powell. So now he can't immediately respond to that. We all know this, because if he does it, he's admitting he's panicked. So he's got to play this silly game. But reality ultimately will win, and reality is starting to expose itself. And I think watch the big banks. You don't even have to look at momentum. As I explained, Citicorp is near its 2022 lows. It's also near its 2020 lows, which were the same. Bank of America is below all lows since mid-2021, and same with Wells Fargo. Now, we know these banks aren't going to fail because the Fed, these are the ones that are too big to fail. So that's not an issue. But the issue is, why is that occurring? If, in fact, the comforting words offered by Yellen and Powell, assuring us that they have all the ammunition needed to, do whatever they want to do. How come these banks don't seem to know that? So you think about that, and I would therefore watch the big 4 or 5 banks, because if you see Citicorp also slip below at new price lows for the last couple of years, something's going on. And yes, they're not going to fail, but it's indicative of something big underlying that's occurring. Now, we also know that as the banks start to panic, and I'm talking, small banks up to the big ones, and tighten their belts, they don't want to be, another Silicon Valley. Okay. So they're going to tighten their belts. What does it mean? It means tighter credit. More demanding to find out, you want to borrow money, it's going to be more demanding to find a available lender. And that could help spark a credit crisis. So anyway, it's a lot of combinations here at work. And I think gold knows that. And I think gold has known that for the last couple of years. And that's why when the stock market dropped 20% last year over year, NASDAQ down 30% year over year, 2022 versus 2021, gold was unchanged. Silver was actually up a couple percent in 2022 versus 2020. How come? I think they knew what was going on in the background and underneath their feet. And I think it's now going on a little more apparently.
No, you mentioned how obviously these too big to fail banks aren't going to fail. I mean, the Fed has to backstop them if anything was to go wrong, but it could cause a credit crisis here. Can you explain more for our viewers what this kind of looks for what this looks like, not just for Wall Street, but also for Main Street, right? Going forward, it sounds like there are further issues even in these too big to fail banks because their stocks are doing so poorly. What does that really look like for the average person out there?
Well, that's one of the problems is I think maybe the Federal Reserve of St. Louis on their website offers a chart of this, but look at growth of debt of governments. You can see that's readily available. Corporate debt, over the last 30 years or so, look how it's increased, and personal debt. So everybody applauded the fact that, several months back, 6 months ago or so, the consumers were using their debit cards and their credit cards, and having a good Christmas and spending their money, feeling good. Well, that really isn't so good when you look at the overall debt ratio. So the individual is in the same position the government is, namely the debt is off the page, and all you need is start punching the pin in a few spots here and there, like suddenly getting layoffs that are being noticed in the unemployment numbers, to where new job growth is slowing, and we're hearing more companies starting to lay off. And this is going to show up in the data points that the Fed watches, which again are lagged data points, just like they're lagged, the data points they look at are lagged. And I think those things will cause a debt crisis. And people say, no, this is not 2008 or 9. I fully agree, except the opposite reason. It's worse than. And we shall see.
We definitely will see, and it will be interesting to continue to track this with you, Michael. If our viewers are interested in learning more of your work, where can they find you? OliverMSA.com. We've got some samples of the work on the site, and you can request some current samples. Thank you, Oliver, for your time, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.